The webinar is being presented this morning by Angus Aston, who is a director and senior financial planner with Wise Investment, and he'll tell you a little bit more about Wise for those of you who aren't so familiar with them in a couple of minutes, and by myself, who's a director of Whitley Stimpson, a local accountancy firm. Just a little bit of housekeeping, if I may, before we start. Angus and I will go through the presentation, and then there will be a Q&A session at the end, time permitting. Hopefully you are now 2 years into the pandemic familiar with the Zoom controls, but on the taskbar, which should be in the middle of the screen, hopefully at the bottom, you will see that there is a chat and a Q&A section. If you click on the Q&A option there, it'll open a text box, and I believe you can start to type your questions, and Angus and I will then do our best to work through these at the end. Given the nature of this seminar, you may have some personal or specific queries in mind. If you do have those, Angus and I will vet the questions before blindly reading them out. And if they are personal, then we won't read them in front of everybody, but we will try and come back to you separately after the webinar by email, and our contact details will be shared at the end. So please feel free to drop either one of us a note if you do have any questions you don't want to raise through this forum. So I think with that, I shall move on and let Angus tell you a little bit more about Wise.
Thanks, Ian. Right, well, I'm pleased to say we're now in our 30th year, having been founded in 1992. We have always been and still are and expect to be based in and around Chipping Norton, a local firm. We don't have national ambitions. What's important to us is to develop good long-term trust relationships with our clients, and the fact that some have been with us from the start over these nearly 30 years, I hope is a testament to that. Our main focus are the everyday things of looking after pensions and investments, planning retirement income. As required, we'll sort of arrange insurance and protection policies, and in particular focus of well, actually not so much today's, but the seminar in 2 weeks is the ideas around inheritance tax planning, how to manage the transition of assets from one generation to the next. There are 6 advisors, including myself, at Wise, with a very good and well established support team of administration and paraplanning and technical research and investment management. So we feel we can offer a pretty comprehensive service in the things that we do. So there we are, that's us. Ian, tell us about Whitley Stimpson.
Thanks Angus. We've been established as a firm of chartered accountants since 1931. So we've just celebrated our 90th birthday year and had a few events for that. We started out as a single office practice based in Banbury, and have since, or over the last 15 years, have expanded across Oxfordshire and into Buckinghamshire, now having 4 offices in Banbury, Bicester, High Wycombe and Witney. We have around 80 staff, and so again we feel we're big enough to deal with the vast majority of questions, queries and assistance that's required, while still being small enough to give that personal service and level of care. We do offer a wide range of services, not just sort of tax advisory and tax planning, but also general business advisory, accounting and tax compliance, so annual accounting, tax returns, etc., a comprehensive audit service, and then we do have specialist sector services, travel agents, various other bits and pieces. So as I say, we do offer the vast majority of things. So if you have got any queries, please do feel free to get in touch. I can see rules are there to be broken. Having said we would do the Q&A session at the end, I did notice one question had come in just before I started talking about Whitley Stimpson, and that was, will the recording of this be available afterwards? And the answer is yes. We're recording it, and Maria will make sure that it's sent out to everybody, or uploaded to our YouTube channel, so that everybody can access that. The boring bits, if I may, the legal position. Angus and I just need to clarify that the content of this presentation represents our personal views, should not be construed as financial or investment advice. All information is based on our understanding of current law and practice, which of course may be subject to change in the future, and past performance is not an indication of future performance. Any investments you make can go down as well as up, and you might not get back the full amount invested. You can tell you're dealing with accountants and financial advisors when there's that level of warning at the start, but unfortunately we do have to do that. So I think I will now dive into the presentation and hand you over to Angus, who's going to give you a little bit of a background as to the case study we're looking at.
Thanks, Ian. Right. So we've contrived a nuclear family, the Montague family, and here are the three generations that we know about. The seniors, Frank and Angela, their children, Caroline and Ben, and associated spouses and children. So we're going to be thinking about all three generations at some level through these two webinars. Unfortunately, we start with some very sad news, which is that Frank has recently died, leaving Angela widowed with various sort of financial questions and challenges and decisions to make. I think we've got a kind of a summary of those. These are the sort of thoughts in her head, really. How can she help the family? She's only been obliquely involved up to this point. She's aware of what they have, but isn't sort of fully au fait with it all. And there are various concerns like having enough income long term. Maybe she might need care. How much is that going to cost? And she also would like to ensure that as much is preserved as possible for the next generations. So we're going to try and cover off these various challenges and questions, starting with the question of income. So we need to make sure that Angela has enough while she's here. Sorry, Ian.
No, I was going to say, I think it's fair to say that that's usually the most pressing concern, isn't it, when we meet people in these sort of sad circumstances, is actually, particularly if they haven't been that involved, is their first concern actually, how will I continue to live? And that is usually the starting point, and then everything else really falls in around that, because once you know what you need to live on and where you are, you can then think about what planning you can do in terms of either giving away or saving and those sorts of things.
Absolutely. So I think the next thing is we have a summary of Angela's savings and assets. So Ian, you're going to run us through that, are you?
I am. I think Angela and Frank have saved very well over the years. They've been very prudent. Their house is now worth just shy of £1 million. Angela and Frank each had their own ISAs, which they'd always done jointly, or not jointly, but equally. So are sat at £250,000 each, and then some cash savings, which they've been putting aside for rainy day funds, if you like, of 150,000. So they've got 1.6 million there of assets, which, and the important thing here is that would, if the worst now were to happen to Angela, potentially be subject to inheritance tax. On top of that, they've then also got Angela's personal pension that she'd been saving into at £150,000, and Frank's pension fund, which is a drawdown fund that Angus will explain a little bit more in a minute, which is 350,000. So they've got £500,000 in pension funds. And the key thing here is that pension funds are outside of the scope of inheritance tax, which is why we've separated the assets in that way when setting this out. We've also just started to look, and from an initial conversation with Angela, her income, guaranteed income, without looking at what could be drawn from her assets, is made up of her state pension of £6,000 a year, and then her widow's pension, which is net of a little bit of tax, £12,000 a year. So her income is £18,000 of guaranteed income per annum. After tax, she's a 20% basic rate taxpayer. So I think then Angus is going to sort of, these are quite often the requirements and the position that Angela might be in.
So we've had an initial conversation, Angela and me, or Angela and her financial advisor, and established the sort of a few basic objectives. She needs overall income of about 40,000 a year after tax. She'd like to help her grandchildren on the way to university or whatever else it is that they might need. She does want to try to preserve as much assets as possible for the next generation, but also balancing that with keeping enough provision for herself in case she needs care in the future. So that's the challenge that's been set for the financial planner. We can start to look at that in a bit more detail. I think the next slide.
Yeah, absolutely. I think just for everybody's sort of awareness, this webinar focuses very much on the income generation and some options that Angela has around the pensions that do link in with maximising the amount that can be passed or left to her family on something happening to her, whereas webinar 2 looks very much more at helping the next generations, possibly making gifts and managing the inheritance tax position in more detail.
Righto. So we've broken down Angela's sort of spending and income objective, that her kind of essential living costs, running the house, running the car, bills, etc., £2,000 a month. And then the rest is the fun stuff. She's still fit and active, and she wants to travel, etc., etc., etc. So that's what makes up her 40,000 a year. And besides the existing pensions, her main sources are the stocks and shares ISAs and the pensions, which actually together make up £1 million. So she's well provisioned for. We're just going to delve into the options that she has. One option that I have not considered, or we've not considered, is something like equity release, borrowing against the house. That's another ball game. It's possibly, you might consider, a last resort, but there we are. We're not looking at that over these seminars. Right. So before we kind of delve into the income, I think there are some important points to draw out in relation to these two pensions, which inform decisions as to what we're going to do. So although ostensibly they look the same, they're a pot of money in a pension fund. Angela's, being her own, she hasn't touched yet. She has various options, but the main sort of broad brush possibilities are that she can take a tax-free lump sum of up to 25% of the value, which at the moment would be 37,500. And then with the remainder, she can either turn some of it to an annuity or draw from the fund on a regular basis, known as income drawdown. any income either from the drawdown or the annuity would be taxable in her hands at basic rate 20% tax, because it sits on top of the other pensions. There are there's another option. If she doesn't need an initial lump sum, she could take a drawdown and treat each payment as a quarter tax-free cash and 3/4 income, and therefore only pay income on 3/4 of pay tax rather on 3/4 of the income. So that might be quite a neat way of doing things.
She can mix and match those options as well, can't?
Yes, you can. So you could put part of it to an annuity, take a partial tax-free lump sum, leaving some more tax-free lump sum available later, etc. Sometimes it doesn't do to overcomplicate things, but those are the options under the new flexible pension rules.
Okay.
Turning to Frank's pension, and this is an important subtle point of the rules, because he died before the age of 75, in Angela's hands as a dependent, anything she draws from it is tax-free for her lifetime. So she could have a lump sum now. She could take all of it out in one go and blow the lot. She could draw off a monthly income or take a chunk out every year, whatever. It'll be tax-free. So although they look the same, they aren't the same, these two pension funds. If she turned part of Frank's pension into annuity, the annuity income would also be tax-free under the rules as they are at the moment. There we are. So that will come out later in terms of informing decisions. Okay, another technical point, and I think this is, if there's a key takeaway from this this webinar, it's this point here. Angela now has the has it in her power to nominate who would benefit from these pension funds after her death. Okay, now she might reasonably assume that she doesn't need to do that, make a nomination, because surely it'll, by default go to her children in equal amounts. And actually probably it would. These things get reviewed by the pension provider, and they would probably come to that decision. However, if she fails to make a nomination in favour of Ben and Caroline, their options are rather limited. So on the right-hand side, if she died before the age of 75, they would receive a lump sum each of, well, on current values, a total of £250,000 each. And because she died before 75, they'd be tax-free. That's great. No problem there. However, assuming she survives beyond the age of 75, which seems pretty likely, that lump sum would be taxable as income in the hands of Ben and Caroline immediately. And that would be an income payment at the current values of £250,000 each. That would sit on top of their own personal income, and let's assume they're higher rate taxpayers because they're both reasonably successful in their careers. Then that lump sum that they receive would be taxable at 40, and a lot of it taxed at 45%. So actually the same or worse than inheritance tax. However, if she makes a specific nomination on both pensions in favour of them, or then they would be allowed to have what's called a successors drawdown fund. So it remains as a kind of pension fund rather than a cash lump sum. And under the current rules, they wouldn't pay any tax immediately. They could defer taking any money from the fund until later, when maybe they're in retirement and are basic rate taxpayers. So by making the nomination, that gives the recipients the flexibility to manage the tax position on that money. Whereas the absence of a nomination means that they have no choice and may well suffer a pretty significant tax charge. So sorry about all the technical detail, but the key point here is that if you've got pensions, make sure your nominations are up to date.
Yeah, I think that's a really important point, Angus, because as you say, if you don't, and you're perhaps already a 40% taxpayer, you could see almost half of the value of this pension just going in tax on day one if not careful. I think I'm right in saying, Anto, that this applies to both of the pensions that Angela, so Angela's obviously inherited Frank's pension, but she also had her own. These nominations would need to be made for both pensions.
That's right. So even though, so looking at Frank's one, even though in her hands, because he died before 75, anything she takes is tax-free for her lifetime. If she survives past 75, the subsequent recipients of that pension would be subject to income tax, even though she isn't.
And that's a key point as well. And hopefully we've now covered it. We have had a question come in, and rather than leave it to the end, it feels appropriate to answer it now.
Breaking the rules.
Somebody's asked, would the pension be tax-free if Frank had been older? And the answer is, if he'd been a little bit older, yes. The key age is 75. In this fictional case study, Frank passed away at the age of 70. So had he died at any point before the age of 75, the pension would continue to be tax-free in the hands of Angela. But had he been 75 or over, any drawdowns that Angela had made from that would have been taxed at her marginal income tax rate.
That's right. I mean, the other point to make is that she could also nominate in favour of her grandchildren, and they would be entitled to receive, you know, they could keep it as a pot of pension, as it were, or be paid a lump sum subject to the same tax rules, but they wouldn't be limited. They could draw it at any age. They wouldn't have to wait till normal pension age. So, which it is, well, 55, soon to be 57 minimum age for pensions, but this type of fund, they wouldn't have to wait. So, for example, even if she survived past 75, supposing Emily, the younger one who's 11, now gets to university age, receives this pot of money, she could draw that, and even if it's income taxable, she would probably not have much in the way of other earnings, so she could probably draw up to, say, 12,500 a year free of income tax, because it would be within her personal allowance. So there's lots of options, and it could be split 4 ways. Lots to think about. Again,
the key here is the flexibility, isn't it, which were introduced by the new rules, or what we still call the new pension rules, although they've been in place for a few years now.
All true. Okay, shall we go back to the income?
Absolutely. So I think we're then sort of looking at, Angela's got these pensions, and we've said one of the options that you might consider, and it would be remiss of you not to consider it, Angus, although they're less popular these days, is to purchase an annuity. So again, I think you'd have a look at what she might be able to purchase.
Well, annuities are not glamorous, but what they do is provide a guaranteed level of income for someone's lifetime, which may be attractive. So thinking about Angela, we reckon she needs 24,000 a year to cover basic living expenses. She's got 18,000 a year guaranteed from her existing pension, so she could top that up by another 6. And supposing she took the money from Frank's pension, it would be tax-free. Just to look at the range of options, if you have a fixed income for life, then the rate is about 6.25%. So to provide 6,000 costs £96,000 of pension fund. Obviously, that's coming off the bottom line that ends up with the family, but it reduces her risk. Similarly, You can have an increasing pension, but that's going to cost you more, or start with a lower level of income. And there are various options there: fixed increase every year, or if you want to link it to the retail price index to inflation, then it's going to cost you even more. So yeah, I mean, for the sort of full sparkling gold standard, 6,000 a year is going to cost about 160,000 of pension fund.
And that's quite interesting. As I sort of said, we're seeing when we're preparing people's tax returns, we're seeing less and less annuities these days, which I know is partly because you no longer have to buy an annuity, but also when you look at those rates, and in this example, Angela's 72, she'd have to live till she's almost 100 to be in profit, if you like, from buying that annuity, and I can see why
that's
they're
true,
not
unless inflation turns out to be sort of particularly significantly higher than it has been. Yeah, I mean, in brief, annuity rates have just come down and down and down and down and down over the last sort of 25, 30 years, as interest rates have fallen. Now, maybe in a few years' time, if we, given what's the sort of current discussions about increases in interest rates, will they go far enough to make a material difference to make annuities attractive again per se? However, if you're particularly risk averse, remember that the alternative with investments is that you must take, you're pretty much obliged to take some sort of investment risk in order to generate income. And particularly with a pension, if you're drawing out of it, will the return on the pensions be enough to meet what you're withdrawing? So it's an option to consider, and I have to say a lot of clients reject the idea. However, there it is. So it would be remiss to leave it out, as you say.
Okay, so if we then dive back to, so we've looked at the options that Angela's got available. So I know that you could have 1,000,001 scenarios as to how Angela could reach her £40,000 income target, and we've just sort of honed in on a couple here.
Yeah.
But if we dive back to that, I'll let you talk through option one.
So if you take the investment, the stocks and shares ISAs, supposing we agree it's sensible to continue investing, but to start producing some income from those ISAs, it would be reasonable and not too much of a stretch to ask for income of about 3% a year, which on $500,000 to combined value of the ISAs, 15,000 a year. Being ISAs, they're tax-free. Supposing she goes for kind of the first of those annuity options, decides for some reason she's not worried about inflation and gets the fixed income. Jam today, please, without taking too much of a chunk out of the pension, 6,000 a year, again tax-free if it's bought with Frank's pension. And then she can continue to draw on the remainder of the pension. And supposing, and this is completely optional, she doesn't have to, but supposing a sort of lightweight withdrawal amount of 3%, that's sort of 7,500 a year. So you sort of tot everything up, and we've exceeded her income target. And you wonder, maybe does she have to take anything at all extra from Frank's pension? But we have some ideas as to what she might do with that surplus. That's a simple one. Maybe we can go a bit further, because at the moment we're not allowing much scope for the inheritance tax planning. So here's another option. Focus only on Angela's ISA, the £250,000 worth, and try and squeeze a bit more income from that, 3.5%, gives you 8,750, again, tax-free. Supposing she wants to sort of hedge a bit, she doesn't mind that some of her essential living costs are covered from non-guaranteed income. So she opts to get 3,000 a year, but wants a bit of protection against the rising cost of living, 3% increase. So costs £67,000 on the rates that we worked out, rather than 96, a bit more left in the main pension, and she draws more aggressively on that. Very flexible. I mean, she could draw 50,000 a year. She could draw one great big lump sum and hand it over to her children if she wanted. So these are contrived scenarios. As Ian said, there are a multitude of options. The eagle-eyed among you might be going, well, why take the money from this sort of tax-free environment of Frank's drawdown pension? Well, it's tax-free for Angela as she draws it. There are rules that allow you to give away additional income, and this very definitely is income. Allow you to give that away on a regular basis, and it would never be subject to inheritance tax. Whereas if the more money that's left in that fund, if Angela survives past the age of 75, we're pretty sure that when it ends up with her children, a good chunk of it is going to be taxed at some stage. Whereas if she can draw some more now, give it away tax-free, they have the use of that money now, then perhaps that's a better option than just leaving it storing up inside that pension fund. Anyway,
and I think
discuss.
Yeah, I was going to say, I think that's exactly it, Angus. She's able to, and it's something we cover in more detail on the second webinar, because that's much more around the potential inheritance tax, Angela's initial inheritance tax position and what she might be able to do to save some inheritance tax. And one of those options, as you've mentioned there, is the gifts out of regular income, and where it's, or regular gifts out of surplus income, I should say. So where we have managed to engineer some surplus income here for Angela, she can give that away. And it's quite an attractive option, we see from talking to people, because they're able to see their children or grandchildren enjoy it, and whilst they're still here and through their lifetime. And it's quite a flexible option. You're not committed to doing something for the rest of your life. They do need to be regular, and we'll cover more on the rules around that next time. But it's quite a nice strategy. And as you say, we are taking money out of a tax-free pot, but by doing so should be ensuring it remains tax-free, rather than Angela surviving as we expect her to the next 3 years and it then suddenly becoming taxable.
So what we've set up here is how to use one part of her assets, being the pensions, effectively to kind of cover, hopefully, both angles of providing her with income, but also through the use of judicious nominations and gifting, maximize the amount of those that will eventually, either now or in the future, pass on to her family, while meeting her income needs, and left open some options on further inheritance tax planning, which, as Ian said, we will delve into in 2 weeks' time. But I think that was everything we wanted to say for today, I think, unless you've got any immediate questions, Ian.
Well, there was a question that's come in, and I think you've just now seems a very appropriate time. So I've been told by Maria that I have to go to the Q&A slide, because it's much better for the recording if we're answering questions with the Q&A slide in the background.
Well, fine.
We've had a question come in. How do you make or register these nominations?
Okay, so all pension providers, so the actual pension company itself, should have a pro forma that you can obtain from them, or ask your financial advisor to get for you, and your financial advisor ought to be talking to you about this anyway, where you can set out your preferences and who you want to benefit in what proportion. And usually there's also some space for some kind of freehand description. If such and such dies before me, then I would like this to happen, etc. I think it's important to bear in mind that these are not hard and fast. It's an expression of your preferences and wishes. It is down to the pension trustees who will review the evidence and make a decision, because they have discretion. Now, this is part of the legal setup of pensions, which enables them to be exempt from inheritance tax. However, as long as your nominations are reasonable, then they will probably be followed. I think a question just came in linked to that, about who can you nominate anyone? If, for example, you don't have any children of your own, yes, is the short answer. Again, subject to the discretion of the trustees, but as long as it's reasonable, then they would follow it. So nephews, nieces, brothers, sisters, charities, etc. I hope that answers that question.
It does, and I think you've just seen the same question that you've just answered. If Angela nominates her children as beneficiaries and they don't actually enact to draw down at all, can they then pass it on again to somebody else?
Yes. Subject to the same sort of set of tax rules. But incidentally, if the money in that successors drawdown fund at the moment is tax-free, growth, any income generated in investments or interest on cash is also tax-free. I mean, the other thing to say is we are relatively early in the cycle of the existence of this concept of a successors drawdown, because the rules came in a few years ago, and the pension holders, in time, more of them will die and pass on these pensions to their children. I'm kind of willing to bet that these rules may be changed at some point, because actually they're quite generous, you might say. Yeah, I mean, we'll see. There could be complications that arise in the future, and because they're not quite treated the same as your own pension fund, there's complexity arising from these, but there it is. That's the rules, so that's what we must work with.
Absolutely, they don't like to make your life easy, although it might be, as you say, the rules are quite generous at the moment. We've had a question come in. What is the tax position on death with ISAs? I think there are two points to this. ISAs are free from income tax during the life of the person who's held them. They are, however, subject to inheritance tax. So they are, in the main, they are an inheritance tax chargeable asset. So will be included in your estate for inheritance tax purposes and tax calculated thereon. The reason I say in the main, I don't want to get too complicated, you can invest through an ISA in certain qualifying investments, which may, after a period of time, usually 2 years, become free from inheritance tax by virtue of business property relief. And
we're going to be looking at that next time, I think.
Absolutely, this is definitely more Angus's bag, but in terms of the shares and the criteria that they qualify for business property relief, but there is a position that they could be free from inheritance tax. I'm not sure quite where you were asking in this question, but I think then we can also say that if let's say, for example, here had Frank left his ISA portfolio to his children, yes, assuming it's not in any of these qualifying investments, it would have been subject to inheritance tax. It would stay within the ISA wrapper as long as it's not liquidated and given to them in cash.
Hold on, no.
Oh.
Wait a sec. It going to children, it does not stay within the ISA wrapper.
Just
Going to a
spouses.
spouse,
It does.
it does. There's a mechanism of retaining that tax wrapper. So we've kind of assumed that in the scenario that everything's gone from Frank to Angelo in his will, and his stocks and shares ISA has been transferred to her as an ISA, but
So
it ends with that generation. It's only between spouses that you retain the tax efficient wrapper. Sorry.
So then if it goes to the children, they could decide to hold the same stocks and shares, but not within an ISA wrapper, and income generated from that would be taxable, yes. Or if they sell the shares, subject to capital gains tax.
Exactly, yeah, that's right.
And then we've had a couple of questions on surplus income, which I think Angus and I would both say the devil is in the detail with surplus income. And again, we cover this in more detail next time, but one is, how is surplus income determined? Who decides, calculates? And there is no set prescribed method as to who decides or calculates, but what you have to bear in mind is that whoever your executors are, whoever's filling in the estate forms upon your passing, there is a specific form in relation to gifts that have been made out of surplus income, and you have to be able to demonstrate that it genuinely was surplus income. So it's all about record keeping. So the starting point is to sit with a financial advisor or your accountant and work through what your committed expenditure is and your expenditure to maintain your current standard of living, and then look at where your income is and see what the surplus is available. From there, you can then start to build up the documentation to support this, to make life easy. As and when the forms
in practice, unless, to be honest, unless the amounts are relatively significant, some people think, oh, I'm not sure I'm going to trouble myself with all that. However, over time, over a few years, it can make quite a big difference if we're talking in the realm of several £1,000s a year. So yeah, I mean, that's kind of why we're looking at it, because it sounds simple, but it isn't quite, because you have to work to get the exemption.
You do. And can you make regular gifts retrospectively? I think, again, it comes down to the detail and what's actually happened. I think if you were able to support that they were regular gifts and they were genuinely out of surplus income and could build the documentation around that, then yes, there's no reason that they couldn't be classified in that way. But it's worth noting, and I think Angus was perhaps just alluding to it there, depending on the amounts, this allowance is in addition to the normal £3,000 a year that you can give away inheritance tax free. And so if the amounts that you've given were less than that, it's quite often easier for people just to treat it as coming out of that allowance and move on, rather than have to prepare all of the support behind it.
Yeah, well, there's a few questions here. So very briefly, there's a question: is there a ceiling to the value of regular tax-free gifts you can give per year? No, provided they are within your surplus income. So that the test case is, I think the revenue challenged a lady who had given not monthly amounts but annual amounts, like into the hundreds of thousands, but she was able to show that her actual income was far in excess of her spending requirements. I can't remember the exact figures, but her income might have been something like £700,000 a year, and she only needed £250,000 a year to live on. So although HMRC challenged the claim that sort of gifts of £200,000-300,000 should be taxable, she was able to demonstrate, or her executors rather were able to demonstrate that she could afford to give the money away. There's a question here. Why did you dismiss equity release as a last resort? Is it not a means of avoiding IHT by giving away the cash released? Well, yes, it is. There are sort of caveats. Obviously, the 7-year rule applies. And I mean, if someone's life expectancy may be relatively long, I don't know. Interest rates are quite low, probably 3% on an equity release mortgage, but that interest will pile up unless the individual chooses to pay the interest. So it's an option, but it's not, to me anyway, and you know, discuss. It's not necessarily a primary one. I mean, the later you leave equity release, the less interest that will accrue on it. But at sort of 3% a year, roughly speaking, the size of the debt, if you accumulate the interest, would double in about 20 years, something like that, there or thereabouts. So, yeah, I mean, again, the interest comes off the inheritance tax bill, but
there is some link there as well with the residential nil rate ban that's obviously now in place as well, that it can help to mitigate the position where perhaps the main home has risen significantly in value over the years.
Yes, well, yeah. I know we're dealing with uncertainties, aren't we? We can't sort of predict the future, but you know, that house could carry on appreciating in value, which is just sort of one of the challenges. The thing about dealing with inheritance taxes is by no means an exact science. I think you have to take the steps that you can. Preemptively, there's a question on the basis the rules are quite generous at the moment on pensions. Is there any anticipation that they are likely to become less so? I mean, that they may change is my personal view. I don't know, but it was sort of a set of rules introduced by a Conservative government. I suppose a Labour government might view it differently. I don't know. That's just my sort of guess, really.
I think the bottom question there, Angus, is quite interesting. With the pension nomination, are we talking about a lump sum or an annual amount that would go to those that inherit it? We're talking about the actual pension pot, aren't we? So that can be divided up. You can make the nomination to, let's say there's a pension pot, arguably £100,000, you could split that between 4 people and give them 25% each, and they could then decide upon inheriting that whether they wanted to draw all of that down, whether they wanted an annual amount. The flexibility sits with the individual rather than the nomination at the outset, I think.
Yes, by making that nomination, so you know, they can choose to take a regular income, they can choose to have a lump sum, they can choose to leave it alone. The other thing to say is that in terms of nominations, I mean, if you've turned some of the pension fund into an annuity, that's it. You know, apart from a couple of sort of minor options, that annuity, that income will cease on the death of the owner, in this case Angela, if she buys that annuity. So it's that trade-off between kind of preserving the capital and having security of income during her lifetime. There are options you can say, well, I'd like it to be, I can guarantee it'll be payable for a minimum of 5 or 10 years. So if she dies before that, then for the remainder of that period, up to 10 years from when the annuity was bought, say, then the income would continue to be payable. You can get temporary annuities where there's a capital value at the end, etc., etc. There's lots of options, but which are sort of too much to go into. But ultimately, you know, annuities, there's no capital to pass on to beneficiaries.
I think I'm going to make this the last question, and there are a couple that we won't have answered where we will make sure that we come back to people separately. How much can be given away free from IHT from the whole of the estate, and is this penalised if I live longer than 75 years? The short answer is you can give away as much as you like. You have to be very careful around making sure that you don't retain benefit from assets you've given away. So for the main one that we quite commonly get asked, can I give my house to my children now but continue to live in it? The short answer really is no, not unless you want to pay a market rent for living in that property to your children. And again, you know, for some people that works, but there are nuances with all of these things. Similarly, and there has been a question about putting money into a trust. Yes, you can put investments or money into a trust, but you have to be very careful on the amounts. And depending how you do it and what you do can crystallize some lifetime charges and things, which I'm not going to go into too much detail on today. But again, there are risks and pitfalls alongside doing that.
That just on picking up on the trust, there are types of trust or schemes that you can set up where the settler, the person setting up the trust, is entitled to receive a regular payment of cash, say monthly or quarterly, for their lifetime, but they're not allowed to dig back into the capital, the money that's been put into the trust. They just have the right to an income stream. It's called usually it's a discounted gift trust, it's called, and it works. The 7-year rule applies. You can put capital outside your estate and still have the benefit of the income. It's a special case. It's quite complicated, but it does work. Yeah, there are pros and cons. So money could be put into trust, but with care, I think, is the short answer. There are some quite technical, there's a quite technical question about ownership of the house. That
I was going to pick up separately.
Right, okay. If a pension beneficiary dies, then if the sort of person who currently owns the pension is still alive, they can make a replacement nomination. If they don't, then it'll come down to the discretion of the trustees, and they may just distribute, you know, I'm speculating, but they may just distribute the total between the remaining beneficiaries who are still alive. That would be a reasonable expectation.
And then the final point, I think I'm going to park until the next webinar, which is how do you prove excess or surplus income if it's derived from investments, which can change dramatically year on year. And I think given that we cover surplus income in significantly more detail next time and look at that, I think that might be better answered as part of that webinar.
Okay. Fine. Are there any more pressing questions?
I think that's answered everything we've got there, and takes us neatly to just under the hour mark. So I think if we finish there, I have moved on to the final slide, which details both mine and Angus's email addresses. So if you do have any questions, queries, or anything else, please do feel free to reach out to either one of us. And all that's left is to say thank you very much for attending, and we hope to see you in a couple of weeks' time on the next one.
Yes, thank you very much, everybody. I hope that was useful.